One reason the rich get richer is because of passive income. Simply by having money that can be used to purchase shares of companies allows the rich to make money even if all they're doing is sitting on the couch all day. Passive income is limited in effort to a degree. $1,000 a month in dividends is an awesome goal, and if you're starting from scratch, it may take you some time to get there. If you're a subscriber, well, welcome back to Investing Few. But if you're new to this channel and you want to enjoy more of our engaging content, make sure to click that subscribe button and use that trigger finger by smashing that like button. Now let's get into it. Are you planning to invest for $1,000 a month in dividends? Earning $1,000 a month in dividends as passive income is a great way to supplement your income or grow your portfolio on autopilot until you need to spend the money. Intentional stock selection can allow you to receive a dividend payment each month. Make sure you do your research first to ensure it's a good fit for your portfolio and not just the calendar. Remember to spread the risk with stocks in different industries. Splitting up your $1,000 monthly goal across multiple stocks ensures you don't have all of your eggs in one or two baskets. Start where you can and grow your portfolio over time. Don't get discouraged if you're not able to create $1,000 in monthly dividend income from day one. The actual amount of money you'll need to create a $1,000 per month dividend portfolio depends on the dividend yield of the stocks you buy. What is dividend yield? It's the return on investment in terms of the dividends you receive for the money you invested. The dividend yield is calculated by dividing the annual dividend paid per share by the current share price. For the money you invest, you receive a percentage in dividends back. Before you start thinking of trying to find higher yields to make this process faster, the usual recommendation for regular stocks are yields in the range of 2.5% to 3.5%. Of course, this benchmark was prior to the 2020 global situation, so the range may flex while the markets continue to swing. And it also assumes that you're ready to start investing in the market while it's moving a lot. For this example, let's keep the conversation simple by targeting a 3% dividend yield and focusing on quarterly stock payments. Most stocks that pay dividends do that 4 times a year. To cover all 12 months of the year, you'll need a minimum of 3 different stocks. If each payment is $1,000, you'll need to invest in enough shares to earn $4,000 per year from each company. To estimate how you'll need to invest per stock, divide $4,000 by 3%, which results in a holding value of $133,333. And then multiply that by 3 for a total portfolio value of around $400,000. Not a small amount of money, especially if you're starting from scratch. Now, you may be thinking that you can shortcut the process and reduce your investment by looking for higher dividend yield stocks. In theory, that could be true, but stocks with dividend yields above 3.5% are generally considered risky. Under normal marketing conditions, higher dividend yields generally reflect that there may be a problem with the company. Driving down the share price raises the dividend yield. Take a look at the stock commentary on stock sites such as Seeking Alpha to see if the dividend is at risk for a cut. While everyone has their own opinion, make sure you're an informed investor before deciding if the dividend is cut. The stock price generally goes down. So then you're out both the dividend income and portfolio value. That's not to say that it happens 100% of the time, so it's your call on the risks that you're willing to take. To have a perfect portfolio to generate $1,000 a month in dividends, one should have at least 30 stocks in at least 10 different sectors. No stock should not be more than 3.33% of your portfolio. If each stock generates around $400 in dividend income per year, 30 of each will generate at $12,000 a year or $1,000 a month. Diversification can help an investor manage risk and reduce the volatility of an asset's price movements and dividend cuts. You can reduce the risk associated with individual stocks, but general market risks affect nearly every stock, and so it is also important to diversify among different sectors. However, the ideal portfolio is difficult to implement because the price movements and company cuts increases dividends. Also, when some stocks go down, you tend to buy more of these stocks to average down the costs, or some stocks rise faster than others. Then your 3.33% of the portfolio would be like 8%. The riskier the stock, the more yield it pays. The faster growth of the stock, the riskier the stock is. Stocks in financial, REIT, and energy sectors tend to pay higher yield than technology or high-growth stocks. A well-diversified portfolio is your best bet for the consistent long-term growth of your investments. In choosing stocks for your dividend income portfolio, you have to consider the do's and don'ts. Start smaller when starting from scratch. In order to earn $1,000 per month in dividends, you need a portfolio of approximately $400,000. Today, that may sound like an impossibly huge number, especially if you're not converting an existing IRA. Instead, start building at smaller incremental dividend goals such as $100 a month. Continue to invest and reinvest over time to reach your larger goal. Now that the large brokerage companies cut trading commissions to $0, it's easier and efficient to make smaller share purchases more often. Aside from the simple reality that in order to cover all months of the year with regular stocks, you'll need to invest in different companies, $400,000 is a large amount of money. Diversifying the companies you purchase stock in spreads the risk. 3 stocks are putting a lot of eggs in a few baskets. If one of those stocks goes bad, a huge percentage of your portfolio would be impacted. And investing in different stocks allows you to cover different industries and buy something at a better value at the time. Maybe divide it up so that no stock accounts for more than $200 or $250 of a single month's dividend income. Look for stocks with consistent dividend payment histories. The only guarantee when it comes to the stock market is that it will go up and down. And the only guaranteed dividend is one that's actually paid out. But starting with stocks with long dividend payment histories generally have a better chance of continuing to pay in the future. The long-term payers usually want to continue their payments in the future because their share price will likely go down if they stop. Company or market conditions could result in a dividend schedule change, or the dividend strategy might change because of a merger or an acquisition. Double-check the stock's next ex-dividend date. Before you purchase your shares, check to see if you'll qualify to receive the next dividend payment. The ex-dividend date means the stock is trading excluding dividend. You need to own the shares before that date to be eligible to receive the future dividend payment. Do a quick check for the next ex-dividend and payments dates. Even if you don't qualify for the next dividend payment, you may still want to purchase the shares anyway. But depending on what's on your watch list, a different stock may be a better purchase for the moment. Check what taxes you may owe on your income. If you're building a dividend income portfolio in a regular brokerage account, not a tax-deferred retirement account, you'll likely owe additional income taxes and paperwork each year. If your goal is $1,000 per month in dividend income, you may make a larger investment to cover the taxes. Talk to your favorite tax professional or the IRS to confirm your specific situation. Don't chase dividend yield rates. It's worth saying one more time. High dividend yield rates in regular stocks could indicate a problem with the company that's pushing down the stock price. Double-check with your company research. Losing both your dividend income and stock value will be counterproductive for your goal. Depending on what your research says, you may still want to take the risk on a particular stock. Just go in as an informed investor with your eyes wide open. REITs, or real estate investment trusts, are a different type of stock investment that's taxed differently, so the dividend rates are typically higher than the regular stocks. Reduce the risk by splitting your monthly payments among multiple stocks. Compared to the smaller monthly dividend goals, $1,000 per month in dividends requires a large investment in individual stocks. And it's worth saying one more time, future results aren't guaranteed based on past performance. It's always possible for dividend payments to end, even with the longest-paying companies. To reduce your risk of one of the stocks having trouble, considering purchasing more stocks with the same payout patterns. Maybe it's 2 stocks that pay $250 per month for the same pattern. A simple dividend planner made in Google Sheets can help you structure and track your dividend earnings. When it comes to investing in the stock market, you'll do the best you can with the information available at the time. If needed, you course correct in the future. Well, will you try investing for passive income? Let us know in the comments section below. And hey, if you enjoyed the video, don't forget to like and subscribe to our channel so we can continue giving you the best content. Thanks for watching, and we'll see you in the next video.